How to improve your credit mix for a higher score. Understanding credit mix and why it matters. When it comes to improving your credit score, most people focus on the big three: on-time payments, credit utilization, and derogatory marks. These are crucial, no doubt, but they're not the whole picture. There's a lesser-known but highly strategic category that could be silently keeping your score stuck, even if you're doing everything else right. It's called your credit mix, and it accounts for 10% of your FICO score. Now, 10% might sound small in isolation, but when you're trying to break into the prime credit tier of 700 plus, or even aiming for elite status in the 800s, every little percentage matters, especially when this part is relatively easy to optimize, if you know how. So let's break it down. What is credit mix? Your credit mix refers to the variety of credit accounts you manage. Not all debts are created equal, and lenders want to see how well you handle different types of credit. Here are the two main types. Revolving credit. This includes credit cards and lines of credit. You borrow up to a set limit, repay, and reuse as needed. It's flexible but requires discipline to avoid high balances. Installment credit. These are loans with fixed monthly payments over a set term. Examples include auto loans, personal loans, student loans, mortgages, and even furniture financing. A healthy credit profile typically includes both types. That doesn't mean you need one of each, just that a balanced mix shows financial maturity. It proves to lenders that you're not just good at managing plastic, but also capable of handling structured, long-term debt responsibly. Why it matters in the FICO algorithm. Let's look at the FICO scoring model, which is the standard used by most lenders in the US. Credit mix sits right there with new credit activity in terms of weight. But it's often overlooked because people focus only on paying bills or reducing balances. But here's the kicker. If you have only one type of account, for example, just credit cards, you may be capping your score's growth potential. Let's say two individuals both have a spotless payment history, low credit utilization, no recent inquiries, similar length of credit history, but one has only revolving credit, and the other has a combination of a credit card, a car loan, and a student loan. In most cases, the second person will have the higher score, even with everything else equal, because their credit file shows diversity and complexity. That diversity gives lenders confidence. It tells them, this borrower can handle multiple financial obligations, structured and flexible, without defaulting. The psychology behind lender trust. Here's why this matters so much. Credit scores are all about risk modeling. Lenders don't know you personally, so they rely on your score to predict whether you're likely to repay a loan. A diverse credit mix signals lower risk. It shows that you can manage monthly loan payments and variable card payments, aren't over-reliant on any one form of borrowing, have experience navigating different financial responsibilities. This becomes even more important if you're planning to apply for a mortgage, business loan, or auto financing. These lenders are often more conservative and want a full picture of your financial experience. That's why improving your credit mix can unlock better offers, lower interest rates, and higher credit limits. And yes, it's a factor that many DIY credit rebuilders completely miss. But this is one of the first things professionals look at when helping clients at wiseconsultant.com, a trusted name in credit repair and financial transformation. They often find that simply adding the right type of account at the right time can create a measurable score increase in just a few months. A word of caution, it's about balance, not binging. Now, let's be clear. Improving your credit mix doesn't mean opening a bunch of new accounts all at once. Opening too many accounts quickly can trigger a spike in hard inquiries, a drop in your average age of credit, which affects 15% of your score, and it might look like you're desperate for credit, which raises red flags. The key is to strategically open or manage accounts that fill gaps in your credit profile without overextending yourself. That's exactly what we'll break down in the next segment. How to diversify your credit mix the smart way, without sabotaging your score or taking on unnecessary debt. Smart strategies to diversify your credit mix, without sabotaging your score. Now that we know what credit mix is and why it matters, let's get into the good stuff. How to actually improve it. And just to be clear, this isn't about applying for loans you don't need or racking up credit cards like a collector. It's about being strategic, adding variety intentionally while protecting the rest of your credit profile. Strategy 1. Add an installment loan, even a small one. If you currently only have credit cards, meaning your profile is purely revolving credit, consider adding a small installment loan. Options include credit builder loans from credit unions or online platforms. Secured personal loans with a deposit. Even financing a small purchase like a laptop or appliance, if you can pay it off quickly. Why this works? Installment loans demonstrate that you can handle long-term financial commitments with fixed payments. You don't need to borrow a large amount. Even a $300 credit builder loan paid over 12 months can move the needle on your credit score. This tactic is especially powerful for people rebuilding their credit. And because the balances are predictable, it's easier to stay in control. Strategy 2. Use a revolving account responsibly, if you don't already. On the flip side, if your credit file shows only loans and no credit cards, you're missing the revolving side of the equation. In this case, opening a secured credit card can help you build history with revolving credit, especially if you've been denied traditional cards in the past. Here's how to use it smartly. Spend small amounts, just enough to keep the account active. Pay it off in full every month. Keep your utilization below 10% of the card limit. The goal here isn't to carry a balance. It's to show lenders that you can handle credit access without abusing it. Over time, this proves that you're a low-risk borrower and can significantly increase your score, especially if combined with on-time payments and low utilization. Strategy 3. Don't rush. Add accounts slowly. One of the biggest mistakes people make when trying to improve their credit mix is applying for too many accounts too quickly. Every time you apply for new credit, it triggers a hard inquiry, which can temporarily lower your score. And if you're approved, it also lowers your average age of accounts, which impacts 15% of your FICO score. So, space out your applications. Only open new accounts when necessary or when it strategically fills a gap in your credit profile. Build a stronger credit mix, the smart way. If you want to take control of your credit score and learn exactly how to optimize your credit profile without making expensive mistakes, at Wise Consultant, we specialize in expert credit restoration services tailored to your needs. Whether you need guidance on improving your score, disputing inaccuracies, or understanding the complexities of credit, the Wise Consultant team are here to help. Visit wiseconsultant.com today to take charge of your financial future. Wise Consulting Enterprise. We could help you in such.